We've just talked about tax rates, and I just want to show you in the books you just have been given on page 18, so Roman numerals 18, that's XVIII. You'll need to know Roman numerals for this course. Roman numeral 18. So tax rates vary from year to year depending on the government, and this is the current rate for 2019. And the provincial rates, I'm flipping the page. Page 20. And here is where we see CCPC, another word for small corporation. We'll talk about the definition later. On page 22, and this is where we see Manitoba of 0. These tables will be really useful to you. I hope that you'll bookmark them, put tabs in them, whatever. They're quite good, and this is a much better place to access this information than in the textbook. Our exams, the midterm exam and the final exam are open book exams. You're allowed to bring in with you the textbook, the Income Tax Act, and whatever other paperwork you want to bring in. Our quizzes are not open book, but the midterm and final are totally open book, including whatever notes scratched on the pages of the books, notes written down on a piece of paper, etc., etc. Bring anything you want in. Hopefully that will take the sting out of paying for the textbook, because it is an open book exam. Just want to segue from rates. We'll come back to it shortly, but I want to talk about planning in general, planning, avoidance, and evasion. And in particular, I hope you might have taken Duke of Westminster in your first tax course. Brief repeat. There's no obligation on behalf of a taxpayer to try to or to maximize the tax amount he pays. In fact, the taxpayer is entitled, not encouraged, but entitled if he or she can, to minimize the tax payable. The closest American case, the judge, his name is Learned Hand. I don't know where that name came from, but that is his name, Mr. Justice Learned Hand. And he made the same point. I think his case was in the 30s or 40s as well. And he also used the word, he referred to patriotism. And you know how big patriotism in the States is in the States. He said, tax planning is not even an unpatriotic thing to do. Tax planning is very much the right of the taxpayer, and a taxpayer who tax plans, not only might the commissioners of Inland Revenue be unappreciative, but that's their problem. And indeed, it is not even unpatriotic to try to minimize taxes. So says Learned Hand. Any questions on Duke of Westminster? We have a continuum where we have planning on this side, evasion over here, and everything else in the middle is avoidance. And we have limits, we have legislated and jurisprudential limits on avoidance. And the statutory one is that we have specific anti-avoidance rules. And we have the GAR, the general anti-avoidance rule. And avoidance is the toughest one to describe what it is. It's one of those things that's like art. I know it when I see it. Actually, I think that was pornography. Can't define pornography, but I know it when I see it. I think that was the actual quote. So the hero of this case is a lawyer. The hero of every case is probably a lawyer. Who said, look, I want to buy a house. I would like to make my mortgage interest deductible. I know that there's a line of court cases that says that the use of borrowed funds in order to justify deducting interest expense, the use of borrowed funds that is considered is the sort of the most direct use of funds as compared to what the money was borrowed for, or when the money was borrowed in the stream of transactions. So look, I will take $300,000 out from the capital account of my law firm. What that means is that the law firm had essentially retained earnings of a whole bunch of money that I guess it was holding on to before next year's draws were paid, or maybe they were going to buy some computers or something. The firm had $300,000. He takes $300,000 cash. That's not a taxable transaction, by the way. That's money that's sort of owed to him by the firm. It's already tax-paid money as far as he's concerned. Takes $300,000 out and buys a house with the $300,000. This was back when you could buy a house with $300,000. And then he goes to the bank and borrows money to invest in his law firm. That is to put $300,000 back in his law firm, which, I don't know, might have happened the next day. You're saying to yourself, well, all we did here sort of made the money spin around in a circle. The result of which, though, was that the borrowed money, which was directly for the use of investing in the law firm, the interest expense on that is deductible. So yesterday, he had no money and no debt. Today, he's got a house and debt. And somehow the interest expense on that debt is deductible. But if you look at his balance sheet, the only thing that's there is a house. Revenue Canada's head exploded. Winds its way out through the courts. Supreme Court of Canada. No problemo. This case, and CRA, or the Department of Finance, never reacted in a way that I thought they might, like changing the legislation or something. I mean, they probably could have added an addition to 21C, which is the deduction for interest expense, and made a way by which this sort of circle of transactions wouldn't qualify. That didn't happen, and nor did CRA change, nor did CRA pick on people who had done this going forward. Today, this is the authority for example, people who have investments but have also bought a house, let's say. If they sell their investments, which might create a capital gain or other income, if they use that money to pay down their house mortgage and then the next day borrow to buy back the investments, they can thank Mr. Singleton, the lawyer, because the authority for that is from this court case. So every investment advisor and lawyer and accountant in the country who advises on investing or tax matters knows about this case, and can get a benefit for taxpayers that they would not otherwise get. In the United States, as you might know, you can deduct mortgage interest expense. You can't in Canada unless you're able to have a setup like Mr. Singleton. In his case, he had to have another asset on the side. His asset was called capital and law firm. But if he'd had another asset like investments or something like that, he could have used those investments in the same way to get his mortgage interest deducted. So this is probably today referred to as planning. Sort of planning is like vanilla stuff. if you have a friend from CRA and you're out for lunch with them, this is something that you and your CRA friend would talk about, and you wouldn't feel shy about it. And the CRA person would say, oh yeah, I know what you mean, yeah. Back in the day though, this was avoidance. This was taking something that was an interpretation, an interpretation made in good faith about how interest expense works, and using it in a way clearly not intended by the Income Tax Act or all the jurisprudence that preceded it, to, I'll say the word, avoid tax. But it got litigated to the highest court of the land and was found to be acceptable level of avoidance. That's about the best case I can tell you to show you what avoidance looks like. And the way you get to something like this is by really out of the box thinking about how a transaction can be structured in a way that's totally different from just going to the bank and borrowing money for your house mortgage. And this is sort of the excitement, honestly, that comes from tax planning, and why I so enjoyed it, and I'm sure Frank does as well. Any questions on avoidance? In the textbook on page 10, I will commend to you to read, and these readings will be posted together with my lecture notes later this week. Types of tax planning. Shifting income from one period to another. Why would that be a good thing? Yes?
It's the same, it's essentially what we talked about before with the corporate, you're basically delaying paying tax, so you can use the money in the meantime to do something.
Exactly. Any others?
You can shift income from one period to another to offset losses.
Correct. So, first example, I'm just going to repeat them so in case the camera didn't hear. So, for example, deferring income by retaining in a corporation. Secondly, by way of using up losses. I might add, you saw that corporate rate chart that had different tax rates year to year. If I'm aware that tax rates are going to increase or decrease next year, there are things that I can do to push income or pull income year to year. That's another one. And then finally, and this relates back to the first point about the integration deal. Man, if I can keep from paying that second level of tax as a shareholder for 20 years, that's just, let me put it this way, accountants say this, $1 of tax deferred is like $1 of tax saved. It is so powerful to push tax into the future. So all of those things combined is what's meant by this number one here, shifting income from one period to another. Transferring income to another entity or alternative taxpayer, incorporating my business. Alternative taxpayer, income splitting between spouses. I'm married to a retired teacher. For better or for worse, my income was this big and her income was this big. And I realized that about age 25, we'd been married since age 22. She won't have a lot of opportunity on her own to create an investment account because her income is only this much. I would like by the time she and I are retired, and honest to God, at age 25, I would like us to have an investment account that's about the same size so that the income earned on that investment account, capital gains, dividends, interest, is about the same between her and me. Because as we said before, we have progressive marginal tax rates, and we can have the lowest tax payable by the family if the if the family members' incomes, husband and wife in this case, are about the same. So starting from age 25, we invested every dollar that she earned. She had a 30-year career as a teacher punctuated by 3 mat leaves. We invested every dollar of her income so that CRA could see her investment account growing and know that all of the income from that investment account came from her investments, which came from her income, and I, as an accountant, could show the trail from her salary deposits into her bank account and then over to her investment account, which was in her name only and didn't have my name on it. From age 25 to age 55, 30 years of growth in her, and I paid for every dollar of house mortgage, car payments, groceries, kids' expenses, everything out of my earnings. And I can tell you that that's a more robust way of doing things than what some couples do, which is they just say, I've got an account in both our names, it's a joint account, I guess we'll just split it 50-50. CRA can just drive trucks through that. The way you show, if you want to do something like this, is by the trail of dollars, her earnings, her investment account, her investment income. That is transferring income to an alternative taxpayer. Otherwise, if we'd spent her money, all of our investment income would be in my hands, which would be no good. We'd pay much more tax than if our incomes were equal. And actually, right now, our incomes are pretty close to equal. Took a long time. Took 35 years. Took 35 years, and the insight at the beginning, because I don't know, I might have been in class, or maybe one of my colleagues by that time said, you know, you should consider this. I thank the person every day, whoever it was that told me that. It certainly wasn't my idea. Hopefully you might do something similar. Along the way, I put the house and my sports cars in my wife's name for creditor proofing reasons. And also to remind me that when I left the house in the morning, I should kiss my wife goodbye, or else I might have to kiss my house goodbye. Number 3 is converting the nature of income from one type to another. Honestly, for salaried people, I don't know how to do that. I don't think there is a way, honestly. For people who have investments, I can buy certain types of investments that will produce dividend income, certain types that will produce income, interest income, others that will produce capital gains. Or, when I sell my business, I'm on page 15 now. I have a corporation that has a business, and I can take dividends out of my corporation and pay tax on those dividends. Or I can leave the money retained in the corporation and then sell the corporation someday for more money. And when I do, my taxable income is a capital gain. And capital gains have different rates from dividends. So I also have some kind of flexibility as regards my personal and corporate situation if I run my business through a corporation, thus changing the type of income from dividend to a capital gain, because I might have capital losses that I can, and by the way, I have capital losses that I can use against capital gains but don't help me against any other type of income. I would love to be able to be in a situation where I could convert some type of income into capital gains. That would suit me very nicely. On page 19, we talk about avoidance and specific and general anti-avoidance rules. Please turn in the Income Tax Act to section 18. So So in the Income Tax Act, if you look at the top corners, pardon me, the bottom corners, (18)(1). To be more clear, Section 18, subsection 1. I might refer to that as 18.1 or 18(1). And I won't call out page numbers, I'll just ask you please to flip based on the provision at the bottom. The preamble, in computing the income of a taxpayer from a business or property, no deduction shall be made in respect of, and now it just goes on forever. Let's look at A. No deduction may be made in respect of an outlay or expense except to the extent that it was made or incurred by the taxpayer for the purpose of gaining or producing income from the business or property. So a test that says, look, if you've got a type of income, income from business or property, which by the way is tailor-made for corporations, because that's essentially the type of income that corporations are. Corporations don't earn employment income. They earn income from business or property. Capital gains aren't really considered income. Anyway, this is tailor-made for corporations. No deduction can be made unless it was incurred, the cost was incurred for the purpose of gaining or producing income from business or property. So a purpose test. Purpose tests obviously are pretty subjective, but honestly, based on a whack of articles and jurisprudence from 1917 onward, 1917 was the birth of what became the Income Tax Act, there's a lot of information on what passes the purpose test. So much so that honestly it's almost a common sense thing today. You can sort of look at expense and sort of determine for yourself virtually as to whether it was incurred or not for the purpose of producing income from the business or property. Just in case that point wasn't made clearly enough, the Income Tax Act in 18(1)(h), so that's section 18, subsection 1, paragraph H. Belts and suspenders. Not only must it be incurred for the purpose of earning income, so says A. H says it can't be incurred for personal or living expenses of the taxpayer. So these are all pretty specific. These two in particular, or all of 18(1) relates to expenses. So a fairly particular type of transaction that is a cost incurred. A couple of others just for entertainment's sake. One of my favorites is L, the bane of partners of law firms. One cannot deduct, preamble again, no deduction shall be made in respect of an outlay or expense for the use of maintenance or property that is a yacht, a camp, a lodge, or a golf course. You cannot deduct golf membership fees. Et cetera, et cetera. The Act is pretty smart. The Act has considered a whole whack of different types of expenses and has prohibited them from being deducted. Please now turn to 67.1. Section 67.1. Pardon me. So this doesn't start with a notwithstanding. So what that means is on top of anything else in the Act, like Section 18, no deduction shall be made in respect of an outlay or expense in respect of which any amount is otherwise deductible except to the extent that it was reasonable in the circumstances. And again, a whole whack of jurisprudence follows. Reasonable? I once saw a skip driver get out of a 2-year-old Jaguar sedan, and I don't know what his deal was. I thought it was, I used to deliver pizza, so I thought he was my hero. But I don't know that CRA would be happy that the expenses in relation to that car were necessarily reasonable in the circumstances. It was probably a temporary thing. In any case, that's an example of a quantum issue whereby CRA might disagree with the quantum of an expense, not so much the nature of it, based on the circumstances. I will commend to your reading, please, and again, I'll post these readings to the course materials page this week. The rest of this column, or this part on restrictions to tax planning. So the specific rules, and then we turn the page to the GAR. I propose to go through the GAR only in about 5 or 8 minutes. Show of hands, though, folks that haven't encountered it in your earlier tax course or elsewhere. Okay. So, Income Tax Act says, look, we think we're pretty bulletproof as far as rules against aggressive tax planning, aggressive avoidance. We've got decades worth of specific anti-avoidance rules. And then a couple of court cases happened in the 80s that sort of blows all that up. The main case was a case called Stubart, which was sort of the same type as Duke of Westminster, whereby the Supreme Court said, you know what, taxpayers have a pretty broad scope of ability to plan, and Income Tax Act, you're going to have to come up with something better if you hope to combat that. We the courts are not prepared to do the work of the Department of Finance. Frank, is that not a bad?
That's a great
summary?
way to say it.
Department of Finance is fine. Section 245 of the Income Tax Act. Canadian tax authorities enacted back in the mid-80s a broadly based general anti-avoidance rule to supplement the more specific rules. And they go through about a 4-stage process. The first is whether a tax benefit was enjoyed. That is, hey, did any tax get saved here or not? If not, let's move on. But if some tax got saved, yeah, we think this could apply, so it says CRA. Let's go to the next step. The next step is we look at whether it's a so-called avoidance transaction. And to do that, it's a question of whether the transaction was entered into for bona fide business purposes. Look at the transaction, say, well, this actually looks like a business transaction. Regardless of what the result was, the purpose, there's that word again, the purpose or the intent was actually to do a business transaction. And that's what got done. Like somebody bought something, or somebody did this or that, spent some money, whatever. And there's a test that says if it's undertaken primarily for good purposes, we're golden. And if we pass that test, again, CRH has to walk away. If CRA thinks they still got something, then we go to the final test, which is whether we have a misuse of a specific provision in the Income Tax Act, or an abuse of the act as a whole. And I'm okay if you don't, if you're not as specific as what I just said. If you just said, hey, it's a misuse or an abuse of a specific provision or of the entire statute, I'm quite okay with that. Referred to as the misuse or abuse. Now if you have, I'll say, failed that test, now CRA can make an assessment to you under Section 245. And that assessment is basically to take away whatever the tax benefit, which we got, which we determined at the outset, whatever that tax benefit was gets taken away. Frank, there used to be, and maybe still is, GAR committees.
Yes.
So nationally and locally, or just nationally, do you think?
Maybe just nationally now.
Yeah. Where CRA people actually get together and look at specific cases. Because honestly, this isn't an easy thing to determine. One CRA auditor or assessor or appeals officer can't on their own do this. It requires really a consensus. So CRA has managed this by pulling together a GAR committee that periodically looks at specific situations. Please open your act to Section 245.1. Frank, your practice is incorporated.
Yes.
Mine never was. It was less common in Manitoba for accountants to incorporate. In my firm, some of my partners in Alberta were incorporated. So I never got to enjoy the benefits. Can you talk about what an
The
awesome
reason why
thing
is when you're a partner in PricewaterhouseCoopers, you have to share the $500,000 small business deduction with
Gazillion.
gazillion people, so it's down to $1,000. It's down to $1,000. What happened when they changed the WIP rules, where now WIP has to be included in income, a lot of partners started to incorporate strictly to avoid the hit at 50.4% on WIP, work in progress, and have it taxed at 27%. Because basically, it's still a deferral, because the tax rate is 27%, which is better than 50.4. But I really don't understand why some partners of national firms did not incorporate, because 27% was almost what the low rate used to be the first years you and I were practicing. It used to be 25% was the low rate when Mr. Martin became Prime Minister. Finance Minister.
And the benefit that you derive from being corporate is much like we talked about here, like deferral, some limited income splitting.
Yeah, the big benefit is, unfortunately, I can't income split because my wife makes too much. I don't blame her for that, but it's the fact that instead of losing 50.4% of the dollars, I lose 9% on some dollars and 27% on other dollars. So there's that deferred taxes, which will probably catch up to me when I die. When I die, I really don't care.
So let's start from there. So let's say you've got 30 more years of life. I don't want to wish any ill. So 30 years. Do you recall what year you incorporated?
I incorporated in 2000.
2000. So you got 20 years plus 30 is 50 years of tax deferral.
Yes.
Yeah, that's awesome.
And and like a lot of my clients, because I took a tax course on real estate investment trusts,
Oh yeah.
I bought real estate investment trusts that the distributions are tax deferred unless they sell the building.
Interesting.
So the returns always is returns of capital.
Right.
So that's the way you also get around the age 65 old age security clawback is you get your funds paid to you as a return of capital, not as income.
I can see I'm going to have to buy you lunch. Tax avoidance, general anti-avoidance rule. Again, cases, a lot of learned papers. This is probably the most important single provision in the Income Tax Act for corporate tax lawyers who are trying to get a handle on sort of what their clients can do or not. In this section, we have a whole bunch of references and then definitions of things like tax consequences and tax benefit. The thing we said before, that's the first test. A reduction, avoidance, or deferral of tax or other amount payable. Savings of tax, essentially. Savings of tax in the current year. An avoidance transaction, sub 3. Transaction, but for this section, would result directly or indirectly in a tax benefit. Tax benefit having been defined on the two previous pages before. Unless it may reasonably be considered to have been undertaken or arranged primarily for bona fide purposes other than to obtain the tax benefit. Series of transactions is something we'll see a lot in corp tax. A series of transactions tests provide CRA with a look back to sort of what happened at the outset, and then. Because in the planner's mind, they're sort of focused more on sort of the result and the final transaction. But a series of transactions, like this series of transactions, becomes fair game for both the general and specific anti-avoidance rules. So we have to go back to sort of the beginning of time in a series of transactions and then recount from there how every step looks or might look to an auditor. Sub 4 says that subsection 2 applies, and subsection 2 says that the tax consequences, the consequences is to deny the benefit. And 4 says that 2 will apply if we have a misuse or abuse. This is the statutory context for the misuse or abuse comment on page 20 of the textbook. And I'll ask you to have a look at 245 more slowly in your own time. Going back to the textbook for a sec, would you please turn to page 'Talk among yourselves.
I was like, I didn't put my hand up. I know. I was like, why is everyone else put up there?
Page 47. Most of these items here apply with regard to compliance. Compliance, broadly speaking, is about things like filing tax returns. complying with administrative rules, et cetera, et cetera, et cetera. The ones that that relate more to lawyers are as follows. Not so much whether they filed returns or not, blah, 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 but fail to report an item of income. So for example, if a lawyer wrongly tells someone about a particular cash receipt or something, and the lawyer counsels incorrectly that it is not income that has to be reported. Knowingly making a false statement or omission. And we're not even talking about criminal penalties here. We're talking about administrative penalties that are eye-wateringly stiff. 50% of the tax owing, et cetera, et cetera. Here is one that can apply to advisors. Misrepresentation of a tax matter by a third party. In fact, we call these third-party penalties. 2 separate civil penalties for preparers. This is you, advisors. Tax shelter promoters, which sometimes are lawyers as well. And valuators who cause or assist others to misrepresent their tax owing. Promoters and other third-party representatives are penalized when they make false statements involving schemes that are against the law. Tax preparers, I won't talk about that. That's crooked accountants who manufacture donation receipts and stuff like that. The interesting part is on the next page, where it says that the tax planner's penalty ranges from $1,000 up to the fee charged for the planning. And I've seen multi-million-dollar fees charged for planning, which the government can confiscate if this third-party penalty is applied. And we're not yet at the criminal part of this, et cetera, et cetera. And in addition, a person who has participated in making a false statement or has destroyed documents to evade the payment of tax is liable to a fine of blah, blah, blah. And this is the one that always caught my attention. I'm shocked there's a 2-year limit on this. I would have, hating tax evasion as they do, put a higher limit on 2 years. That's scary enough. I don't need to add to that. Just know, please, avoid taxes all day long. Your clients will love you. I will love you. But don't evade taxes. That's a bad thing. That's actually a good place to pause. Let's come back at, I've got, the ghost of Steve Jobs says 2:43, so let's make it 3 p.m., which is in 17 minutes. That's about the same. Yeah. Good. See you at 3.
No, I run a sole because I like filing my own taxes. You can't file it.
Well, you can file, but you.
No, because that's CPA file.
But you can still check it.
Sure, but you still have to pay them.
You just don't put
But
it
you
But
need
you
to
don't have to
document
pay.
it.
Well,
But,
outsource it, you didn't pay tax. You can do it.
yeah, because it's done. But, you know, I have issues. Because there's our home-based business.
You can claim your phone. Or part of your.
I played, well, part of my,
Part of your-
portion of my rent. Yes, you better believe it. Rent.
A portion of your gas expenses.
Yes, hydro, cable, phone, insurance. I essentially run a nonprofit.
Appeals that case.
Well, no, because Liz makes more than I do, so all this things, because I don't qualify, so. Yeah.
You can read it.
But if you go on like if you TurboTax or whatever, it's like at a certain point, TurboTax is like, you can't file this online. You gotta mail this in. I had to mail it in signs. Yeah, yes, yeah, that's fine. Well, you have to remember that operating a business outside of the jurisdiction, in a different I have like local jurisdiction, it's like, yeah, oh yeah, it's just, but yeah, and they're just like, yeah, no, you can't file this online. So, like, ship it in.
You file multi-jurisdictional tax returns?
Yes, sir.
Really?
By hand.
That's the only way?
Because you have to do it that way.
It's like that thick?
Yeah.
I myself
Yeah.
have to, yeah.
Printer cartridges.
That's
Yeah.
right. No, I just go to Staples now. Yeah.
I deduct those.
Wow.
But yeah, I was flipping through for all the CCA deductions this year. And I'm like, yeah, no, we're doing it. If I'm filing by hand, we're doing it. We're taking everything.
Does that include Quebec?
Huh?
Quebec as well?
No, just Manitoba and Alberta. And yeah, so we're just like, yep, we're doing it.
I have to file it in every province, including Quebec. Yeah, my tax returns.
Yeah, that sounds not like fun.
That's a lot.
My firm, I still get a share of profit from my firm. My firm has business in all 10 provinces.
This is the way we're talking.
PwC. And